Hey, John, listen, let's jump right on into this because I almost cannot believe what's happened to mortgage rates over the last 8 months.
I can't either.
At the beginning of the year, and you can't quote rates on the radio because you have a license to sell mortgages, but I can. At the beginning of the year, they were like 5%. In January, there were people closing on loans that were 5%. And I'm telling you, people are getting locked in lately at 3.375, 3.5%. So when you think about it, and I'm sure you've got some examples of how this is helping. I mean, people will pay 33% less interest today on the same loan as compared to January of this year.
Yeah, I mean that's nuts math, and how it's been helping folks is that the big problem last fall and in winter was people's buying power. They had really gotten to a point where homes had appreciated in value and interest rates had gone up to where they simply didn't qualify for the home that their family needed, or it's very difficult to qualify.
Right.
And now all of a sudden that math has changed, and we can go out and find that same family, the same home, and the payment works within their budget, and we can make that deal happen.
I'm thinking if their interest rate on their loan is any higher than 4.5%, I'm not saying refinance would be the thing for them to do, but I think it would probably be worth them looking into. Would you agree?
100%.
Is 4.5 the number, or is that too high, too low?
I don't think that's too high.
Okay.
It really is. It really depends on the individual, because a lot of 4.5% rates may be paying a lot in mortgage insurance premiums. So if we can accomplish two things at once, knock the interest rate down a point or more, and reduce or eliminate the mortgage insurance that they pay, then that's going to be a win-win that's really going to make that refinance profitable.
Last time we talked, I think you were thinking that Brand Mortgage was going to have a new down payment assistance program, something you were associated with. Any update on that?
Yeah, we got it working. It's still got some wrinkles to iron out, but we are rolling it live as of September. So we're ready to go with it. It operates on just a normal FHA type of a mortgage.
Okay.
Where you typically have to have 3.5% down.
Okay, 3.5.
But we've partnered with some new investors within the secondary market that will allow us to borrow that 3.5% down payment. We've had versions of this in the past where interest rates have been just out of whack, 3.5 points above the normal market rate, never really made it where it was a viable option.
Okay.
That's not the case with this program. We do the normal FHA mortgage.
Okay.
But then we also provide the borrower with a 3.5% second mortgage.
Okay.
Okay. And we have two different options for that second mortgage based on the borrower's personal qualifications, where sometimes you have to pay that 3.5% back. Sometimes it's forgiven as long as you make 36 months of on-time payments.
Wow. How does it get determined whether or not it's forgiven or whether or not they pay it all back?
Okay, so if it's going to be forgiven, the interest rates are going to be a tick higher, just a tick.
Okay.
Number one.
Okay.
Number two, if it's going to be forgiven, you have to be within certain income caps for the borrowers that are on the loan. You can't make too much money. Okay.
Right. And so is it a percentage of the average household income in the area that you're looking for? Okay.
It's exactly right. It's 115% of the average income.
So if you're under that number, then there's a chance you could get one of these mortgages and the 3.5% would be forgiven.
That's right.